Does this sound familiar? Your parents bought their first house in the 90s for $200,000. Now, the same house on the block that you grew up on is now going for $2 million. Their mortgage payment used to be $600 a month, but for today's buyer, $4,200 a month for the exact same house. But you know the part that makes people really mad? Your parents, when they bought that house, they were 28 years old and they were making $35,000 a year. Today, you would need to make $168,000 a year in annual salary to afford that same house. But what is the median income for 28-year-olds in the US today? It's $45,000. My name is Alice, and I'm a millennial who grew up with this disaster, and I want to show you exactly how an entire generation of us, millennials and Gen Zers, got scammed out of home ownership. And more importantly, what you can do about it, because what I'm about to reveal will change how you think about the biggest purchase of your life. If you're new here, I'm a CPA and Chief Financial Officer, and I also own my own wealth management firm. What we're experiencing right now with real estate, or in the past 20 years, is not a normal market cycle. It's actually a fundamental restructuring of who gets to own homes and real estate in North America. And it didn't happen by accident. So let's start with the first one, the scam that's hiding in plain sight, the mortgage interest deduction. Now, politicians love to go on and talk about what they do to benefit voters. And they talk about this one specifically as a benefit for homeowners, but it's actually a very big wealth transfer from young people to older, wealthier homeowners. And some would argue that it's actually fairly inefficient at promoting home ownership for lower and middle income class families. So this is how this one works. If you own a home in the US and you pay US taxes, you are allowed to deduct your mortgage interest from your taxes if certain criteria are met. Now, this sounds really great in theory, but the catch is that the bigger your mortgage and the higher of a tax bracket you are in, the bigger the benefit that you will get. In fact, the mortgage interest deduction doesn't actually change your tax return and how much tax you owe if you don't have enough deductions to itemize over the standard deduction. Let me show you the math by going over a few examples. Let's say we have a family that's making $50,000 household income and they live in California. They have a modest home with a $300,000 mortgage. They likely would not be able to take advantage of the mortgage interest deduction because most middle income households with only a mortgage on a modest home actually don't have enough deductions to itemize. And therefore they would just take the standard deduction because that would make more sense to them, where they don't get the benefit of the interest deduction to begin with. In comparison, let's say we have a $200,000 income family with a $600K mortgage at a 6% interest rate. Depending on the exact year of the mortgage they are in, they would get on average about $8,000 per year in tax savings. And for a upper class family that's making $500,000, they would get $15,000 per year in tax savings. So this is where it gets really interesting because this tax break actually puts upward pressure on housing prices because buyers are technically willing to pay more or borrow more knowing that they will get this tax deduction. So this benefit actually gets priced into housing prices. And some economists estimate that the mortgage interest deduction raises US house prices by roughly 5 to 10%, which actually mostly benefits the upper middle and the higher income households, again, who are able to itemize versus taking the standard deduction. Lower income families who take the standard deduction don't see any benefit. And so this deduction or the existence of it doesn't actually help them afford homes anymore. The policy was made back in 1913, and it made more sense back when people were able to buy homes in cash. But with modern mortgage lending today, it's become more of a machine that transfers wealth from renters and younger people to wealthier, older, retired homeowners. With the existence of MID, sellers also recognize this in the market as well, which again puts this upward pressure for listing prices to go up. And as a result, MID, or the existence of it, pushes average home prices up. The Congressional Budget Office actually estimates that this deduction costs the government $25 billion a year. That's $25 billion in tax breaks that mostly go to people who already own homes, funded by everyone else, including those people who can't afford to buy homes. The second factor that has scammed an entire generation out of housing is probably the one that upsets most people the most because it is very artificial. And these are zoning laws that make it non-compliant to build and have affordable housing. So in most American cities, it is actually not compliant to build anything other than a single family home on 60 to 75% of residential land. This is what we call single family zoning. Basically, local governments control land use through zoning laws. And single family zoning means that on every given lot, only one detached house is allowed. So as an example, in San Francisco, let's say, there are certain neighborhoods where you could technically, with the size of the land available, build a 4-unit apartment building or 4-unit complex that would house 4 families affordably. But because of zoning laws, the government says that we can only build 1 single family house on there. And then because of that, that house costs $2 million, as opposed to 4 units that might cost $600,000 or $700,000 each. A lot of local governments and policymakers will argue that this is about preserving neighborhood character and, it is about protecting the housing prices for existing homeowners. The thing is, when you artificially restrict any sort of supply, but demand keeps growing, and the reason why demand keeps growing is because the population keeps growing, prices will go up. But many existing homeowners, these are people who've been in the market for a long time, your boomers, your people who are about to retire, they want to protect their property values, and so they will lobby against or argue against this idea of changing zoning laws. But if you look at countries like Japan and Germany, they build housing where people actually need it. But in North America, and specifically in America, they have zoning laws that create restrictions around supply where people specifically need it. And anytime you limit supply, that always drives prices up. Now, these zoning laws were created back in the 50s and 60s. And back then it was intentional to keep certain groups of people out. There tends to be a lot of political resistance around zoning laws because, again, local politics always will favor existing homeowners and existing residents who generally, no matter where they live, dislike density changes. Zoning laws definitely impacts housing. Now, the third thing that scammed an entire generation out of housing is the systematic takeover of the housing market by investors. And sometimes these are investors who live offshore or live in foreign countries, or they are institutional investors like funds and other corporations. And typically these are parties who don't live in the homes themselves. They're buying purely because they see it as a way to park their capital or put their money into so that they make money off of it. Since 2010, a lot of investment buyers, these are things like funds, foreign investors, and corporations, they've bought millions of single-family homes. They often pay in cash and have a lot of access to capital, especially if it's an institution, and they can easily outbid a regular family. In 2021, it was noted that investors bought 25% of all starter homes. And in some markets, investors even buy up to 40 to 50% of all homes sold, which there isn't anything wrong with allowing institutions to invest in real estate, but they generally do treat housing like a stock portfolio, and it puts families, young families, at a huge disadvantage. Because for a young family who sees a home as a place to raise a family and live life, when you go out into the market to make an offer, after you've been pre-approved, you are basically potentially competing against some of these bigger fish. It's not uncommon for markets that are really, really hot for there to be 15, 20, even 30 bids on a single property. And sometimes these are cash investors that come in. These are people with good jobs, educations, and are contributing members to society, but they just ultimately, with their salary, cannot compete with a institutional investor or an overseas investor. And investors, they often just see these single family homes as assets that can generate them cash flow. And they often turn them into rental properties, and they convert ownership opportunities into permanent rental situations. And unfortunately, it's always the party with the most amount of money that has the most amount of power, right? And so because of that, these entities, these investors, whatever you want to call them, they end up literally stealing home ownership from some young families and selling it back to them as rent. Some of these companies own tens of thousands of homes. For example, Invitation Homes, they own over 80,000 single-family rental properties. American Homes for Rent owns over 50,000. These are not your average mom-and-pop landlords or people who've just purchased multiple properties. They are literally Wall Street-backed firms that treat your neighborhood like a commodity, as if they were investing in gold or soybeans or corn, right? And it's not just domestic investors. Again, foreign buyers that are looking to park money in stable US real estate, especially if the foreign exchange rate encourages them to do so. Some of these people have bought hundreds and thousands of homes, and they often leave them empty as investment vehicles. Sometimes they also get tax advantages as well that regular home buyers don't, depending on where they live and the tax laws. they may or may not be able to deduct certain expenses and pay lower tax rates on their profits. The last factor is the one that is a little bit more hidden in plain sight, and that is how inflation and monetary policy have transferred wealth from younger savers to older asset owners. It was supposed to help the economy recover after the 2008 recession, but it also had a huge side effect in that it caused asset prices, all assets, not just real estate, but especially real estate, to go up. So when the federal government keeps interest rates low, the cost of capital or the cost to borrow is low, and it becomes generally cheaper to borrow money to buy things. So this drives up the prices of pretty much everything, but especially assets, stocks, bonds, real estate, which is really, really good if you already own assets. But it's really hard if you are trying to get into the market or build up your asset portfolio today, because maybe back in 2008, you were only 5 or 10 years old, right? So since 2008, home prices have gone up 180%. The stock market has gone up 400%. But average salaries across North America have only gone up 30%. So let's say you were 25 years old in 2008 and you didn't own any assets yet. Well, you kind of got screwed. But if you were 45 in 2008 and you already owned a home or a bunch of stocks or other assets, then you naturally rode the wave and made a lot of money. In the previous generation, a lot of these people have seen their housing values double or triple. They've built a ton of wealth, and millennials and Gen Zers saw the houses that they wanted to become completely unaffordable. And it's created this huge wealth gap in American history. And it's causing more and more people who haven't entered the real estate market to become more and more priced out as every year goes by. Now, there's some other countries who also had similar monetary policies of low interest rates, but they also built more housing and had better zoning laws. In America, combined with asset inflation, housing supply restrictions, kind of saw the worst of both worlds. And the people who made these policies already owned assets and benefited from their decisions, but people who didn't, again, maybe because they were only 5 or 10 years old in 2008 and didn't have the ability to earn money and invest at that age, they ended up getting hurt. There are so many things that are outside of our control, and a lot of the things I've talked about today are heavily determined by the government and external forces that we can't really control as individuals. So if you're wondering what you can do about it today, I want to talk about a couple of things to keep in mind. The first is that, it's not really going to be realistic for people to be buying and living where their parents may have bought and lived. So there's this thing called geographic arbitrage, where it basically means that younger people are now moving away from trendy coastal cities to more affordable markets in America. So it's not living in LA, New York, Toronto, or Vancouver anymore, but moving to cities like Pittsburgh, Cleveland, Kansas City, and certain parts of Texas that still have homes under $200,000. And yeah, you might make less money in those cities, but if you can afford to purchase a house for $150,000 instead of $600K or $800K, then it allows you to get ahead financially. The second strategy is to rent out certain parts of where you live or be resourceful about the property you do own. So this is really common in cities with very, very expensive real estate. And that's for a family to, for example, buy a whole house or even buy a duplex and just live on one side and rent out the other, or buy a single family home and live on the upstairs and rent out the downstairs. Even in some places, we have like laneway houses and stuff like that. It's a very, very common practice in markets that are expensive. But basically the idea is that you're using your rental income to help you pay off the mortgage. And this is how you basically compete with investors yourself, is to become an investor and make the actual place that you live in, turn it into an actual asset being something that actually you can make money off of. Because if you purchase a property and you live in it 100%, it's not really an asset in that it's not generating you any income. It's just a place that you're living in, right? And then the third strategy is, looking into potentially other alternative ownership models. So if you can't get into real estate yet, investing in REITs or even non-traditional home ownership opportunities like land trust, co-housing, shared equity. So these options can help you get into real estate so that your money is being put into real estate when traditional buying of owning a home is not yet possible. Then the last strategy is to build wealth first and then buy. I actually quite like this strategy quite a bit, because if you think about how much the US stock market has gone up, 400% compared to real estate, which has gone up 180%. I'll leave a video up top there where I talk about the difference between real estate and stocks, but actually putting your money in the stock market, the returns that you get are much, much higher than real estate. But the difference is that with real estate, you get the leverage of debt. So if you're not able to buy yet, sometimes renting and investing the difference can actually build more wealth than owning an expensive home outright, especially if you are going into a 30-year mortgage with a very, very high interest rate. Because basically those first 5, maybe up to 10 years of home ownership, when the interest rate is very, very high on a big mortgage, it's almost all interest. And so there are scenarios where mathematically it does make more sense to rent and invest in the current stock market than to buy something where you're only paying interest for the first large chunk of the mortgage. So for example, if you can rent for $2,000 and invest $1,500 monthly versus buying a house with a $3,500 mortgage payment, but $3,400 of it is going purely to interest, then you might actually be better off renting and investing for 5 to 10 years. And if that can help you get ahead, because that will all be your money, and it helps you reduce the amount of interest that you pay, or maybe helps you shorten the amortization period that you pay on the home once you do buy it, it can actually be a better financial decision for you. If this video opened your eyes to how the housing market really works and has worked in the past 20 years, make sure you smash that like button. If you like my honest, no BS personality and how I provide financial guidance and advice, make sure you subscribe to the channel and turn on that notification bell so that you are notified every time I post a new video. I did create a very valuable zero-based budgeting tool in Excel, which is free for you guys to download if you want to check it out. I think that creating a budget is one of the most important parts of personal finance, just understanding where your money is going in and out and how to allocate your money to investments and future decisions. So I'll leave a link down in the description. I read every single comment of yours, so make sure you leave me a comment down below if you have any questions or thoughts about what I'm saying, and I will see you guys in the next one. Until next time.